Europe's so-called banking union is in the making. The objective is to protect Europe's state budgets in the event of major banking failures. The burden shall no longer be on the taxpayers, but mainly the owners, creditors, and institutional investors, and the banking industry itself will have to foot the bill. The banking union comprises a common responsibility for financial market supervision, the restructuring or resolution of credit institutions, and the deposit insurance in the European Union. The actual banking union in Europe, however, is work in progress. The first stage, which was decided in the fall of 2013, involves a common banking supervision. The common banking supervision set up by the European Central Bank will start operating at the end of 2014 and will supervise only the 130 largest of the currently 6,400 European banks and credit institutions. Before this, the ECB will review the balance sheets of these 130 European banks and conduct a stress test to check their solidity. The second stage of the banking union was decided only at the end of 2013. The aim here is to create an EU-wide resolution mechanism. In this case as well, the focus will be only at the 130 largest banks in Europe. The new resolution mechanism involves the following steps. Distressed banks and their owners must first attempt to raise fresh capital themselves on the capital market. If they fail, the shareholders, bondholders of the bank and institutional investors will be bailed in. Only afterwards will the European Resolution Fund kick in. In the upcoming years, credit institutions must pay contributions into this fund until a total sum of 55 billion euros is reached. Therefore, the financial sector will also pay for any banking failures in the future. Initially, only within the national framework, but as of 2025, also for banking failures in other EU countries. Critics point to the fact that the money in the Resolution Fund will become available on a Europe-wide scale only in a decade, and then the sum of 55 billion euros will just be enough to cover bankruptcies of smaller banks only. A new body, which will be made up of national supervisors and the representatives of the EU Commission, will decide on the use of the fund. If the EU Commission is against the majority decision in this body, the last word will lie with the EU Ministers of Finance. No consensus is likely to be reached in the near future on the third pillar of the banking union, which is a common deposit insurance. Nonetheless, some progress has been achieved. The EU member states, the European Commission, and the European Parliament reached agreement that deposits are to be guaranteed in the future throughout the EU up to an amount of 100,000 euros. In the future, savers should also be able to get their money faster and more easily in the event a bank goes bankrupt. The European Banking Union is slowly starting to take shape, but until it takes its final shape, at least 10 more years will have passed.